everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my European opening market comment for August 4th. Well, today is Bank of England Day. There's no question that the Bank of England is going to do something at the Monetary Policy Committee meeting after a string of very weak post-Brexit data. The market's pricing in a 100% chance of a rate cut today. The vast majority of economists forecast a 25 basis point cut to 25 basis points. The market sees rates bottoming out at around 11 basis points, which means after today, only half a cut is priced in. So that means one way the Bank of England could surprise the markets then is by expressing a willingness to cut further, perhaps even to implement negative rates, although Bank of England Governor Carney has previously come out against negative rates. There's more debate about the asset purchase program. Most economists see that remaining unchanged at $375 billion, although some are forecasting an increase up to $525 billion. From my point of view, it's hard to see what that would accomplish, though. 10-year gilt yields have already fallen almost in half to just 80 basis points. Nonetheless, the Bank of England's balance sheet hasn't expanded as much as the other major central banks, and so they do have some room in that department if they feel it would be useful. Now, a cut in rates and no change in the asset purchase program is now fully priced in. It'll take more than that to cause sterling to weaken further, in my view. In fact, I think we could see a buy the rumor, sell the fact, or the other sell the rumor, buy the fact response to the meeting. Look at the Australian dollar. It's stronger now, at least against the US dollar, than it was before the RBA cut rates. The recent price action in sterling, in the yen and Aussie suggests to me that investors are losing their faith in central banks' ability to manage the economy and their currencies. The inflation report, which will accompany the announcement, will include the bank's first public forecast of the impact of Brexit on the UK economy. I expect they'll lower their forecast for growth from the current 2% expected this year and 2.2% for the next two. I'd expect them to forecast at least a small recession sometime in the next 12 months, which would help to justify the need for policy stimulus now. Now, one reason they might have to lower their growth forecast is to justify cutting rates at the same time as they raise their inflation forecast. Given the collapse in sterling after the vote, a higher inflation forecast seems likely. As for the U.S., I'll deal with the U.S. indicators right now because the only major indicator out this afternoon is factory orders. That's expected to be fairly grim, but that shouldn't be a surprise to anyone given the large 4% month-on-month drop in durable goods orders during the month. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.